Good morning. Let's walk through what the past few days look like in the global financial markets. We have a short trading week in the United States with the upcoming July 4th holiday. Over the past 2 days, global financial markets have shown strong bullish sentiment, especially in U.S. equities, with major indices like the S&P 500, NASDAQ, and Dow Jones reaching new record highs. This rally has continued even as economic data has been mixed. Core inflation ticked up slightly, and both personal spending and income declined unexpectedly. Central banks are taking different paths. The European Central Bank and Swiss National Bank have started cutting rates, while the U.S. Federal Reserve and Bank of England are holding steady, though markets expect the U.S. to ease later. The U.S. dollar has weakened broadly, mainly due to expectations of future rate cuts. This has been reflected in the bond market, where U.S. Treasury yields have generally declined, while German government bond yields have risen. This divergence in bond yields highlights the different monetary and fiscal policies being pursued globally. The weaker dollar benefits U.S. exporters but makes U.S. assets less attractive to foreign investors. Meanwhile, unusual options activity, especially high put volume on major indices, suggests some investors are hedging or cautious, even as stocks rally. In the business world, there have been several notable regulatory filings. Compass Diversified reported accounting irregularities, leading to a class action lawsuit and concerns about corporate governance. WW International emerged from bankruptcy, significantly impacting shareholders. Global Net Lease received a credit rating upgrade, which should lower its borrowing costs and broaden its investor base. Politically, the U.S. Senate is debating a major tax and spending bill that proposes large tax cuts and spending reductions, creating fiscal uncertainty and sparking heated debate. U.S. equity indices have shown remarkable resilience, with the S&P 500 posting its best May since 1990. The rally has broadened beyond large technology stocks to include financials, industrials, and even discount retailers. European and Asian markets have also performed well, with Germany, Japan, and India all seeing gains. First quarter earnings for S&P 500 companies were strong, with over 13% year-over-year growth, led by the largest tech firms but with solid contributions from other sectors. Analysts expect continued earnings growth for the rest of 2025, driven by steady profit margins, artificial intelligence-driven productivity gains, and a broader base of earnings contributors. Consumer confidence has also rebounded. The market's leadership is expanding, which is a positive sign for resilience and sustainability. Investors are increasingly confident in the broader economic recovery, which could lead to more capital flowing into value and cyclical sectors. However, the economic picture is mixed. Core inflation is above target, personal spending and income have fallen, and GDP contracted in the first quarter. This disconnect, strong markets despite weak data, suggests investors are focused on the prospect of future rate cuts and easing trade tensions. But this also creates fragility. If the Federal Reserve is less dovish than expected, or if the economy slows further without enough stimulus, markets could correct sharply. A key driver of optimism is the expectation that artificial intelligence will boost productivity and corporate profitability. Companies like NVIDIA are seen as leaders, and there's a belief that AI is a structural shift, not just a passing trend. This is leading to significant investment in data centers and related infrastructure, benefiting a wide range of technology and industrial firms. U.S. Treasury yields have generally declined, reflecting expectations for rate cuts, while German yields have risen. This creates opportunities for investors to trade the spread between U.S. and European bonds. The bond market is grappling with conflicting signals, persistent inflation versus signs of economic slowdown. The yield curve is in flux, and its shape will be a key indicator of the market's long-term outlook. The U.S. dollar index has hit a 3-year low, falling about 9% since the start of the year. This is mainly due to expectations of U.S. rate cuts. The dollar's weakness has been broad, with the Japanese yen and euro both gaining. Currency markets are also reacting to trade policy changes, such as Canada's reversal of its digital services tax and ongoing U.S.-China trade negotiations. The Chinese central bank is keeping its currency stable, and the Swedish krona is also performing well. Commodity markets have been mixed. crude oil prices fell sharply due to easing Middle East tensions, which reduces inflationary pressure and could give central banks more room to cut rates. However, this has hurt energy sector earnings. Grain prices fell on good weather, and gold prices dropped despite a weaker dollar, as investors shifted from safe havens to riskier assets. Platinum and copper had strong starts to the week, but lost momentum. The Federal Reserve kept rates steady in June, reaffirming its dual mandate of maximum employment and stable prices. Inflation remains above target, and economic activity is slowing, creating a policy dilemma. The market expects rate cuts in 2026, especially if a more dovish Fed chair is appointed. The Fed is balancing the risk of reigniting inflation against the risk of deepening the slowdown. Other central banks are on different paths. The European Central Bank and Swiss National Bank are cutting rates. The Bank of England and Federal Reserve are holding. The Bank of Canada is expected to cut further, and the Bank of Japan is raising rates. This divergence is shaping global capital flows and currency values. The Fed is managing liquidity through its repo and reverse repo operations, especially with the upcoming debt ceiling event. Money market funds have grown to record levels, reflecting a demand for safety and liquidity. Yields on these funds are attractive, drawing in both retail and institutional investors. This suggests that, despite the stock market rally, many investors remain cautious and are keeping capital in low-risk, liquid assets. Recent Treasury auctions have seen strong demand, especially from foreign investors, even as yields fall. This shows continued confidence in U.S. government debt. In the options market, there's been a surge in put buying, indicating that some investors are hedging against a possible downturn, even as volatility measures like the VIX decline. Beyond the headlines, companies are making major investments in data centers, AI, manufacturing, and health. There's a push for sustainability, with new initiatives in recycling and the circular economy. Some companies are restructuring or shifting to asset-light models, as seen with Hyatt Hotels. These moves reflect a focus on long-term growth and adapting to new technological and environmental realities. The U.S. Senate's major tax and spending bill is a source of uncertainty, with debates over its impact on the deficit, social programs, and green energy investments. The bill faces strong opposition and could have significant economic consequences. Trade policy remains fluid, with Canada and the U.S. working to resolve disputes, China's manufacturing under pressure from trade frictions, and a tentative U.S.-China trade truce in the works. Globally, a development finance conference in Spain is addressing the gap between rich and poor nations, but U.S. withdrawal complicates efforts. Looking ahead, the bullish momentum in equities is likely to persist, driven by optimism about AI and expected monetary easing. However, volatility could rise if economic data disappoints or central banks change course. The U.S. dollar is expected to stay weak, especially against the euro and yen. Treasury yields may decline further if rate cut expectations solidify, and the divergence with European yields could continue. Oil prices will remain sensitive to geopolitical events, and gold may stay subdued unless risk appetite wanes. For investors, opportunities include increasing exposure to value and small-cap stocks, especially those benefiting from lower rates and economic improvement. The AI infrastructure theme remains strong, and longer duration bonds could benefit if yields fall. Currency strategies might focus on a weaker dollar, and select corporate situations, like Global Net Lease's credit upgrade, offer potential. However, risks remain, especially in companies facing governance issues like Compass Diversified. In summary, markets are optimistic but fragile, with strong equity performance, diverging central bank policies, and significant political and economic uncertainties. Investors are balancing risk-on sentiment with caution, as shown by flows into both stocks and safe assets. The coming days will be shaped by central bank signals, economic data, and political developments, with opportunities and risks closely intertwined. Thanks for watching and have a safe week.